Hi and welcome to the 14th issue of my newsletter. Today we will talk about Stochastic, MACD and RSI, few of my favorite indicators. In this video I will dig deeper into some of the most frequently used indicators, as I said, Stochastic, MACD and RSI. So let's start with Stochastic. The definition: a technical momentum indicator that compares the closing price to its price range over a given time period. The oscillator's sensitivity to the market movements can be reduced by adjusting the time period or by taking a moving average of the result. Okay, that's the two of the most common ways to trade. Okay, Stochastic on its extremes levels, which we will see in a second, and divergences. As a momentum bound, we have the 0 up to 100 range. That's the range of this oscillator. Stochastic is mainly used to find overbought and oversold levels. The common levels we use are 70-80 would be the overbought and 30-20 would be oversold. By default it comes 80-20. And the divergence of Stochastic, it forms when a new high or low in price is not confirmed by the stochastic oscillator. Bullish signal would be when price makes lower lows while stochastic makes higher lows. Bearish signal would be when price makes higher highs while stochastic makes lower highs. So let's take a look. So this is first of all the sell zone, the overbought, and this is the oversold zone. And that's how divergence look like. Okay, so basically if we treat on oversold, once price would be on the top, we would be looking for sales opportunities like here, like from this top, like from this top, and from bottoms we would be looking for possible reversals to the upside. Of course it's not 100%, nothing is, but it's a very powerful tool, could help us a lot. And for divergences, that's what we have, and you can see here the basic idea: higher highs, lower lows, higher lows, higher highs, lower lows, higher lows. Every time an indicator shows the opposite direction, comparing the same lower lows to lows on the chart, it gives the opposite direction: lower lows, higher highs, lower lows, higher highs, lower lows, higher lows, and so on. This is the power of the divergences. Using divergences in the extreme zones above 80, below 20 would produce better results, of course, and better entries. You can also use these levels as exit points to maximize your profits. A major drawback in stochastic is that it gives very early signals, so you should consider this when you are trading and confirm it with more tools. The next one is the MACD. By definition, it's the moving average convergence divergence indicator. It's one of the most well-known and used indicators in technical analysis. It used to signal both the trend and momentum behind a trading instrument. The MACD indicator is comprised of two exponential moving average, in short it's EMAs, covering two different time periods, which help to measure the momentum. The MACD is simply the difference between these two moving averages, which is practiced originally a 12 period and 26 period EMA. The MACD is plotted against a center line along with the 9 period EMA, which is referred to the signal line. The idea behind this momentum indicator is to measure short-term momentum compared to long-term momentum to help determine the future direction. That's basically all. Now we have a few ways to trade it. Okay, two of the most common ones, that's crossover and divergences. So crossover, when the MACD line crosses over the signal line, cross up bullish signal for a buy, down bearish signal, and divergences like with stochastic, when the directions are opposite between the MACD to the chart. So that's how it looks like for the cross over. Okay, you see the crosses. Okay. By the way, note that every time the crosses, the moving average crosses, like here, then that's exactly the point where the histogram is the one that shows the distance between the two moving average inside. The bigger the histogram, the bigger the moving average distance, like here and here. Okay, so every time we have a cross, that's where it changes from bearish to bullish. Okay, it's centered by zero level. Everything above is bullish, everything below is bearish, negative or positive, of course. And every time it crosses, it just goes above or below the center to make the bullish or bearish area. And that's how it looks like with divergences. Exactly the same idea like we had with stochastic. Prices go up, prices go down on moving average plus histogram. Okay, they could appear on moving average only, on histogram only. The best combination when divergence appeared compared to both histogram and moving average. And here is the opposite, of course. MAs only, and lower lows on the chart, higher lows on the indicator. Opposite means divergence. RSI, by definition, is a technical momentum indicator that compares the magnitude of recent gains to recent losses in an attempt to determine overbought and oversold conditions of an instrument. Overbought level considered to be 70 and 30 by default, for 70 overbought, for 30 oversold, but I would suggest you change to 80-20, much more powerful and much more respected levels. We can use it by this, and of course by crossovers and by divergences as well. Divergences principle is exactly like the stochastic and MACD which we saw. Opposite directions between the chart to the RSI will hint on a divergence. That's how it looks like basically. Okay, higher highs, lower highs, bearish divergence, we expect a drop. Lower lows, higher lows, we expect a rally. Higher highs, lower highs, expect a drop. Lower lows, higher lows, we expect a rally. That's the same idea. And the crossover, of course, above the extreme area, as I said, could be 70, could be 80. 80 would appear much less, of course, very rare, but much more powerful and more respected. And 70 is much more frequent and common on use. So cross above and down could signal that we are going on the downside. Cross below and up again, we should be looking for buy side, and that's basically the entire idea here. That's basically all. That's the basics of the three indicators. I really advise you to open your platform now and check the material from today's video. Get the feeling on how things work in reality, live time. And spoiler alert, the next email will be one of my all-time favorites, the Bollinger Band. That's our contact details. Feel free to contact me and my support team for any question you have. We are here to assist you with all. Thank you very much for your time, and I'll see you on the next issue. Yours, Vladimir Ribakov.